So, Elon Musk's saga of buying Twitter and not buying Twitter has finally concluded on Tuesday after he proposed to buy the company at the originally agreed on price of $44 billion. Elon Musk proposed in a letter to Twitter that the company disclosed in a filing Tuesday with the U.S. Securities and Exchange Commission. It came less than 2 weeks before a trial between the two parties, which was scheduled to start in Delaware. Twitter said that it intends to close the transaction at $54.20 per share after receiving the letter from Musk. Trading in Twitter stock, which had been halted for much of the day pending the release of the news, resumed trading late Tuesday and soared 22%, close to $52. Now, this has been a very high-profile saga involving the richest man and the most influential social media platform. And much of the drama has played out on Twitter itself, with Musk's more than 100 million followers saying that the company was failing to live up to its potential as a platform for free speech. By completing this deal, Musk essentially gave Twitter what it was seeking from the court: specific performance of the contract with Musk, meaning he would have to go through with the purchase at the original price. The contract Musk signed also had a $1 billion breakup fee. I do believe that Musk went along with the deal because had the trial happened, the judge would not only force him to close the deal, but also impose interest payments that would have increased its cost. I think the most surprising thing I get out of this is that Elon Musk didn't even try to negotiate the price. He just kind of went with the original deal, which was $54.20. And surprisingly, a lot of legal experts also said that Musk would have anticipated that he would lose because things weren't going well for him in court. And the judge will most likely would have favored Twitter. Now, Musk's main argument for terminating the deal was that Twitter was misrepresenting how it measured spam bot problem. And Twitter had been working to pick apart Musk's attempts to get a third-party data scientist to bolster his concerns. Now, the crazy thing about Twitter is that Elon Musk didn't want to buy Twitter. So, the future of Twitter, even if you're buying the stocks, it just doesn't look too good. Now, let's talk about some interesting data that we saw on Tuesday. So, job openings in the United States have dropped by 10% from 11.2 million in July to 10.1 in August. The number of jobs available in the United States plummeted in August compared with July, a sign that businesses may be pulling back further on hiring and potentially cooling high inflation. Layoffs ticked up in August but remain at a historically low level, according to the report known as the Job Openings and Labor Turnover Survey, or JOLTS. And slightly more people quit their jobs in most cases, likely for better jobs elsewhere. The sharp drop in job openings will be welcomed by the Federal Reserve, which is hoping to reduce the demand for workers by raising its key short-term interest rate. While workers typically welcome larger raises, the Fed sees the current pace of wage increases at about 6.5% a year, which is unsustainably high and a key driver of inflation. Feds hope that their interest rate rises, the fastest in roughly 4 decades, will cause employers to slow their efforts to hire more people. Fewer job openings in turn would reduce the pressure on companies to raise pay to attract and keep workers. Smaller pay raises, if sustained, should ease inflationary pressures. In their effort to combat the worst inflation in 40 years, the central bank has raised its key short-term interest rate to a range of 3% to 3.25%, up sharply from nearly zero as recently as March. The Fed has warned that the central bank's rate increases will likely lead to higher unemployment and potentially a recession. The Fed hoped for a softer landing in which the economy slows down to curb inflation, but not so much to cause a recession. Christopher Waller, a member of the central bank, said that the Fed's rate increases may be able to reduce job openings and therefore inflation pressures without causing widespread job losses. Next, let's talk about Treasury yields. Treasury yields fell across the board for the second day on Tuesday as traders weigh actions from the central bank going forward. The benchmark 10-year Treasury was down 3 basis points to 3.621% after having surpassed the 4% mark last week. The yield on the policy-sensitive 2-year Treasury was flat at 4.099%. Yields and prices move in opposite directions, and 1 basis point equals to 0.01%. Like we talked about earlier, there are about 1.1 million fewer job openings than expected in August. These are providing potential early signs that a massive U.S. labor gap is beginning to close. Available positions total 10.1 million for the month, less than 11.1 million according to the JOLTS report. Moreover, markets are also continuing to observe the unexpected decline of the US Purchasing Managers Index or PMI data for the manufacturing sector, which measures factory activity. So let's talk about today what happened in the stock market. After a terrible September for the S&P 500, in October, the S&P 500 has jumped already 5.7% this month, making it the biggest two-day rally since March 2020. The key to the stock market rally has been a sudden downturn in bond yields this week. Also, soft American factory and US job opening numbers. Now, this speculation shows that there are cracks to appear in the US economy and in the inflation story, and that the Fed pivot, a move towards dialing back its aggressive interest rate hikes, could just be around the corner. Wall Street sees light at the end of the Fed's rate hiking tunnel, and the scramble to pick up stocks is on. Investors are growing confident that the peak in rates was made last week. Stocks are posting the best two-day rally as Fed rate cut bets are also back on the table for next year, and given markets were extremely oversold at the end of September. Now, all of this increasing S&P 500 activity is very interesting because 86% of CEOs running the world's largest companies foresee a recession in the next 12 months, according to data from the KPMG 2020 CEO Outlook. 71% of respondents project a recession will reduce company earnings by up to 10% over the next year. The survey also found that 46% of corporate chiefs are considering downsizing the workforce in the next 6 months. So, right now there is just so many different factors affecting the market, and there is no small indicator to say that the Fed will pivot. There are so many different elements that will impact the Fed's decision to hike interest rates or not. And all of this speculation, as you can see today, the S&P 500 is in the green. So I hope you enjoyed this video, and I shall see you in the next one. Bye!